Hi, I'm Julie Price, and welcome to the fourth quarter 2019 economic review. So I saw a tweet the other day from Neil deGrasse Tyson, and he said something to the effect that we are prisoners of the present, sandwiched between the inaccessible past and the unknowable future. So if you think about this in terms of investments, it can be kind of scary. And we can respond to that fear in a couple of different ways. We can cocoon ourselves in and be worrisome of the big day, or we can choose to be engaged and learn. There are economic occurrences that are measurable and we can learn from them. And that's what I'm going to walk you through today. So we're going to talk about risk-on assets, which are stocks, U.S. and non-U.S. stocks, real estate, those types of investments. And then we're going to talk about risk off, which is essentially bonds. And then we're going to spend some time talking about China. So here we go. I like to start off the quarterly reviews with this chart I refer to as the matrix. If you look down the year-to-date column, you can see that all asset classes have been having a great year so far. And the highest performing asset class is REITs, real estate investment trusts. But following right behind it is large cap U.S. equities and small cap U.S. equities. And further on down, we see emerging market equities. And just a reminder, emerging markets are equities from countries like the BRICS countries, Brazil, Russia, India, China, South Africa. And if you look at this light purple square, you can see in 2018 it was the lowest performing asset class, but in 2017 it was the highest performing asset class. So if you just kind of step back and look at this chart, you can see every year that the purple is all over the chart. In fact, most of these boxes are all over the chart. So it's just building a case for not to chase performance just because an asset class has done well in the past doesn't mean it's going to do well in the future. And it's also a case for building a well-diversified portfolio. So that white asset allocation box, that's a 60% equity, 40% fixed income blend of those asset classes. Here we have the S&P 500 price index, a representation of the 500 largest stocks going all the way back to 1996. Here we had 100% run up going into the tech bubble and about a 50% decline. And then we had another 100% growth period and a 60% decline. But here's the story. We've been on a 340% increase ever since. And here we are now today. The price earnings ratio at the S&P helps us understand if the market is overvalued or undervalued. For example, the P is the price. So if you have a stock that's trading at $15 and it's earning $1, then P over E is 15 over 1. So you have a P/E ratio of 15. Why is that important to know what the P/E ratio is? Well, what it is, it's a earnings multiple. It tells us how much money investors are willing to pay for $1 of income. So here we have the 25-year average of 16.22. So on average, investors have been willing to pay $16.22 for a bucket income a year. And currently, where they're at is just a little bit above that line at 16.82. So the market could be considered to be a little bit overvalued. And if you look at some of these other metrics, most of them are also seen a little bit overvalued, but it's still within, normal range here. But let's look back at right before the tech bubble. And people are paying 24 times income over here. They're paying $24 for a bucket income a year. And I knew that this was crazy, and everybody in the industry knew that it was crazy. And we were all talking about it on an almost daily basis when the crash was going to happen, because it just didn't make sense that people would pay this much money for for little, or in some cases no income. So what if you have no income? You're paying $15 a share divided by 0. Well, that's nothing. You can't divide anything by 0. So some stocks don't even have a PE ratio. And sometimes stocks are down here where we saw in the Great Recession in 2008, you saw a PE ratio around 10. So those $15 numerator in that fraction just decreased down to $10. So now we have 10 for the price and still say $1 for the earnings. So now you have a PE ratio of 10. They can get really low and they get questionable if there's other things that come into play if they get to be too low, and other questions that come into play, but definitely we don't want to see them high like we did back in the 2000s. So the market is pretty close to being valued properly. It's important to have a sense of business confidence when you're trying to determine where you're at in the business cycle, mid-cycle, late cycle. And the chart on the left has these gray bars, which are historical quarterly corporate earnings. And the green bars are analyst expectations for the next 4 quarters. You can see there are definitely drop-offs in quarterly corporate profits during recessions, and even a little bit of a drop-off before then. But analyst expectations are strong in the next 4 quarters, so that's good. You can see on the chart on the right, though, that quarterly operating earnings and sales do see some drop-offs before the recession, and so those will be things that we'll continue to monitor. Here is the normal sloping yield curve example from 2013, and here is the blue line where we're at today. Here the 1.75 rate, the 1-year rate, just now increased higher than the 10-year rate of 1.68%. The Fed's going to meet a couple more times this year before the end of the decade, and I suspect that we might see another decrease in rates. It's the rate that they're decreasing is a 1-day rate, so it'll take time for it to work its way into these rates. But I think that will be a positive direction. It may uninvert this line, it may not, and even an uninversion may not deter us from a possible recession. And that's why we're monitoring this. I refer to bonds as a risk-off investment, but they're certainly not without risk. They're lower risk than stocks for a couple of reasons. So when you buy a bond, you're a creditor, you're loaning money to a company. And so if that company were to go bankrupt, you as a creditor would get paid sooner. Stockholders, the owners, would get paid last out of whatever remaining proceeds are available. And bonds pay a stated rate of interest and are usually repaid, so they're generally safer than stocks. If you look at the yield, though, the yield on all types of bonds have been falling, and all of the yields in the 930 column are lower than the yields in the 630 column. And we've seen some pretty high returns on fixed income because of this. And the 30-year Treasury is at 22%, and we just don't see this in fixed income. We're seeing this for a couple of reasons. The Fed has been adjusting rates, and that's going to have some significant impact. But we've also seen some volatility in the stock market, which has caused investors to run toward quality, and so that's part of it, is just they've been bidding up the price. And the chart on the right illustrates the inverse relationship between bond prices and interest rates. And so if we saw this illustrates what a 1% fall in interest rate would look like across the board. Now, the caveat here is that assumes a parallel shift in the yield curve, which is a big assumption. But you can kind of get the sense of what returns could look like if we saw as much as a 1% fall in interest rates, which I don't really think we're in for. But they affect bonds with longer durations, and the corporates are a little bit more affected than like the munis and the mortgage-backed and floating rate. So the chart on the left looks at U.S. debt to GDP in three categories: government, household, and non-financial corporate. Let's first look at the light blue line, household. Households had increasing debt from the early 2000s, which capped off with the Great Recession, and then Americans have been doing a good job keeping their debt under control, and they're right about at 20-year lows. So congratulations, Americans, on paying down your debt. Corporate debt has been on the rise, and so that's not a really great indicator, so we're keeping an eye out for that. But what's really astonishing in this chart is how the government debt has increased since the last recession. It's just been on a nonstop spending spree, and now we're at the point where we're at 100% of GDP. This is concerning, and I'm not sure how we can continue to sustain this, but what we can do is look toward other countries that have similar economies, like Japan. Now, Japan's debt is 230% or more of GDP, and so we're keeping an eye on Japan and the possible Japanification of America. Things in the market sometimes can drag your investments down a bit, or they can give them a boost. We refer to these things as headwinds and tailwinds. Just like on a plane, you have tailwinds that make your trip a little faster. You also have headwinds which can slow you down. And currency effect has that effect on your portfolio, where sometimes it helps and sometimes it hurts. So when the dollar is strong, your investments in international investments are hurt. And when the dollar is weak, it helps your international investments. So if you look at this chart, it compares the local return compared to the US dollar return. So let's just look at Japan, for example. So in 2019, the local currency return was 9.9. So that means if you were a person living in Japan in that currency and you bought into that market, that would be your year-to-date return. But an American investing in Japan is going to have that added effect of currency, because currency was a tailwind in this example. So the US dollar return was 11.5. So sometimes you see the US dollar add and sometimes you see it detract. When we evaluate international equities, we're going to want to look at global trade. So if we look at the left-hand chart, we can see that global trade has been shrinking at its latest measurement, negative 0.9%. Looking back, Europe and other countries went through the same Great Recession that we did, but they went through a double recession in 2011 and 2012, and it had muted growth ever since. Looking at exports as a share of GDP, we're going to break it down between two types of countries: emerging market countries and developed market countries. So Taiwan is the largest exporter by far, and they export quite a bit to emerging markets, which are countries like these. And they also send quite a bit of exports to China, which is represented in the purple bar here. Mexico is the United States' biggest importer, and which is represented by this gray bar. China exports a smaller amount of their GDP to the United States, but they have a large GDP and it is significant. developed markets, Canada is the United States' largest trading partner or largest importer. And here in the purple bar is what the U.S. exports to China. Looking at global tariffs, we can see the current tariffs are in gray. So Brazil has the largest tariff at about 8%, but you can see over here they have a relatively smaller piece going to the United States. China and Canada and the U.S. have been making making tariff changes in the last couple years. So those are all represented in blue, future ones in purple. But these have been the countries that have been involved in the game. So although our outlook is cautiously optimistic for international equities, shrinking trade volume and trade wars are sources of downside risk. Here we have a hypothetical illustration of the business cycle. It starts after a contraction with the recovery period into expansion and contraction. At this point, another business cycle starts. We don't know how many chapters are in this story, but there is some indication that we're in late cycle. Fed policy has been contractionary, and we've seen rates increase, which inverted the yield curve and caused recessionary fears. And then lately we've been seeing decreases in the interest rates, and so that may lead to an uninversion. But let's talk about China. They've been experiencing a slowdown for a few years now, and the trade wars aren't helping. Many economists say that Chinese are in a growth recession, and that's just simply growth that's so slow that's not technically a recession, which is 2 successive quarters of negative GDP growth. The Chinese government has been pumping money into the economy to combat the shrinking exports and the sluggish economy. The Chinese government and economy are very different from the United States. So about 30 years ago, the government went to its citizenry and told it that it was going to have double-digit annual growth in exchange for their democratic rights and freedoms. So in the past, whenever the growth rate wasn't up to their standards, then the government would infuse and invest in the economy. And you can see that right here happening after the 2008 global financial crisis. The Chinese government just infused massive amount of cash and buying and increasing infrastructure and things to help the economy be able to recover. But they've been experiencing slower growth for a number of years here, and they're just right now at 6.2% for the year so far. And the Chinese government is trying to steer away from investing in the economy and relying more on the consumer to consume. The problem is that wages in China haven't really kept pace with inflation, and so the consumer don't really have more discretionary spending available, and they are the world's biggest savers, and so it's really hard to get them to spend when they're looking at these trade wars. And another way that the Chinese government gets money into the money supply is by lowering the reserve requirements. So Chinese has a central reserve bank just like we have the Fed, and they just have recently been ratcheting down the reserve requirement, which allows banks to loan more. So that's another way that they're getting money, that they're stimulating the economy. And then finally in the bottom right, we've seen that their deficit has been increasing, so they've obviously been spending more. Thank you for watching my fourth quarter 2019 market review. Congratulations, you've made it all the way through. So we talked a little bit today about risk-on and risk-off investments. It's important to know what kind of investments bring more and less risk. And it's really important in order to build you a well-diversified portfolio that's customized according to your risk tolerance. If you have any questions, please feel free to reach out to me. I'd love to hear from you. Thanks and have a great day.